$23.86 billion in total revenue, yet Wall Street is terrified this explosive growth will trigger a catastrophic oversupply. Is Micron building an impenetrable empire, or are they walking directly into a cyclical trap that will wipe out early buyers? Let us uncover exactly what is happening under the surface. Look closely at the 196% year-over-year revenue growth reported this quarter, reaching $23.86 billion in total revenue signals that Micron is riding an unstoppable structural shift in the memory sector. Revenue simply measures the total money brought in by sales before any expenses are deducted. This hypergrowth establishes a perilous baseline for your portfolio because expectations are wildly detached from historical norms. The golden rule of stock market analysis is that when top-line growth accelerates this fast, any slight deceleration turns a revenue peak into a devastating liability. To grasp why this $23.86 billion revenue peak is fragile, we must carefully examine profitability. During this unprecedented cycle, gross margin hit an astonishing 74.4%. Gross margin is the percentage of revenue left over after paying the direct costs of producing goods, and hitting 74.4% is exceptionally rare. The media excitedly calls this a margin miracle, celebrating Micron for demonstrating absolute pricing leverage over enterprise buyers. Yet this positive narrative ignores the harsh reality of peak pricing because average selling prices jumped over 100% in a single cycle. Extended periods of extreme pricing power prompt major customers to aggressively seek alternative storage technologies. For your portfolio, the fundamental analysis lesson is that a 74.4% gross margin is rarely a sustainable plateau. Any sequential contraction in this crucial metric will immediately signal to the market that pricing leverage is evaporating. This terrifying possibility brings us directly to the massive elephant in the room regarding their future growth plans. Corporate management recently decided to unleash a staggering $25 billion capital expenditure program. Capital expenditure represents funds a business uses to acquire, upgrade, and maintain physical assets like fabrication plants. Analysts view this $25 billion capital expenditure as a necessary fortress-building exercise to absolutely dominate future artificial intelligence memory requirements. But this colossal deployment carries severe execution risk, requiring flawless facility construction and uninterrupted data center spending. If global technology demand slightly falters, these leading-edge fabs could rapidly transform into underutilized assets bleeding capital. As a smart investor, you must relentlessly watch their $25 billion capital expenditure guidance over the coming quarters. Sound investing strategy dictates that securing future market share is entirely meaningless if it inadvertently triggers a devastating cyclical overbuild. Building this monumental infrastructure inherently requires immense amounts of liquid cash. Generating $20.3 billion in operating cash flow over 6 months certainly provides Micron with a phenomenal financial fortress. Operating cash flow precisely measures the actual cash brought in by regular daily business operations of the company. This extreme liquidity allows the company to self-fund its massive expansion without relying on expensive external financing during periods of global uncertainty. But locking up $20.3 billion in operating cash flow into capital-intensive projects heavily tests investor patience. The clear trade implication is that this aggressive cash conversion must eventually yield superior long-term dominance, or it finances an industry-wide supply glut. For your active portfolio, Micron must continually prove this massive cash hoard is a strategic weapon, rather than a margin-crushing dead weight. How corporate leadership manages this financial weight directly impacts their ultimate survival in the cyclical hardware sector. By aggressively prepaying $4.19 billion in debt principal, management quietly and effectively bulletproofs the entire balance sheet. Wall Street predictably interprets this massive debt reduction as highly prudent risk management from seasoned executives. However, intentionally pushing the debt-to-equity ratio down to exactly 0.14 actually signals a highly defensive, incredibly cautious posture. The debt-to-equity ratio formally compares total liabilities to shareholder equity to clearly show exactly how much debt finances corporate assets. This pristine balance sheet reveals that Micron is actively preparing for severe market volatility and brutal future pricing pressures. The key investing strategy lesson here is that a deeply conservative 0.14 debt-to-equity ratio is absolutely necessary to survive massive capital outlays without facing immediate ruin. Speaking directly of shareholder rewards, this highly defensive posture radically impacts the bottom line numbers you care about the most. The sudden leap to $12.07 in diluted earnings per share transforms Micron from a cyclical hardware vendor into an elite profit engine. Diluted earnings per share formally shows a company's total profit divided by all outstanding shares. Eager novice investors immediately see this bottom line explosion and falsely assume the stock valuation will simply compound forever. Unfortunately, hitting exactly $12.07 in diluted earnings per share instantly recalibrates sophisticated institutional valuation models, completely stripping away any margin of safety for future earnings misses. What does this highly elevated benchmark actually mean for your own portfolio? It unfortunately means you are permanently trapped in an expectation loop where only flawless quarterly execution will prevent brutal stock corrections for Micron. This intense, unending pressure to continually perform leads directly to how the company currently treats its loyal shareholders. Despite generously declaring a dividend increase, the actual capital return profile remains remarkably tight and highly restrictive. The incredibly low 1.4% dividend payout ratio fully exposes a remarkably stark capital allocation reality hiding in plain sight. The dividend payout ratio explicitly tells you exactly what percentage of corporate net income is distributed directly to loyal shareholders in cash dividends. Management is deliberately hoarding its cash windfall to fund physical capacity expansions, effectively prioritizing infrastructure dominance over any immediate shareholder gratification. Retail investors actively looking for substantial yields from Micron will suddenly find themselves entirely subordinated to the global expansion mandate. To truly understand how they fund this mandate, we must dissect the cloud memory segment revenue, which recently reached an astounding $7.75 billion. This incredibly concentrated success powerfully showcases the undeniable market momentum currently driving massive high-bandwidth memory adoption. But relying so heavily on exactly $7.75 billion in segment revenue inherently creates a massive single point of failure tied directly to just a few powerful data center operators. Mastering true value investing requires actively acknowledging that these highly concentrated operational liabilities can erode core profitability just as fast as traditional market failures. All these incredibly complex, highly intertwined risk factors eventually converge on the absolute true measure of executive management efficiency. Achieving a spectacular 30% return on equity vividly demonstrates incredible operational efficiency in rapidly converting corporate capital into massive profits. Return on equity accurately measures financial performance by dividing net income by shareholders' equity, clearly showing how effectively management uses investment dollars to grow earnings. Nonetheless, the rapid expansion of the massive asset base, including a massive $1.8 billion fab acquisition cost, continuously raises the denominator in these critical profitability metrics. If these highly unproven assets experience minor ramp-up delays, the stunning return profile will fundamentally deteriorate quickly. The severe trade implication here is that magically maintaining a 30% return on equity will rapidly become mathematically impossible if the new manufacturing facilities fail to generate massive operating cash flow. This inherent vulnerability brings us smoothly to another crucial financial metric that vividly reveals their deep underlying operational conservatism. Building rapidly on this immense operational efficiency, available cash and short-term investments surged dramatically to $14.59 billion. Most seasoned analysts correctly view this vast liquidity pool as the ultimate safety net for Micron during prolonged periods of intense global uncertainty, yet actively amassing $14.59 billion in cash and short-term investments, while deliberately executing only $650 million in share repurchases, highlights a truly glaring contradiction. Management is severely limiting stock buybacks despite posting record net profits, clearly signaling they deeply view the upcoming market cycle with extreme caution. The crucial value investing lesson here is that when highly informed corporate insiders aggressively hoard immense cash instead of aggressively buying back their own stock, your portfolio should inherently prepare for imminent market turbulence. This rigid, highly defensive liquidity management strategy inevitably clashes with the steadily rising operational costs of doing massive business internationally. Adding significantly to this immense operational pressure, the company effective tax rate unexpectedly jumped to 14.7%. The effective tax rate represents the exact average percentage a global corporation actually pays in strict taxes on its total earned income. A 14.7% effective tax rate actually reflects the mandatory implementation of completely new international minimum tax rules, permanently wiping out previous highly lucrative regional corporate incentives. For your dynamic portfolio, this heavily implies that even with perfectly flawless corporate execution, a larger portion of their hard-earned operational profits will be systematically siphoned away by shifting international regulatory environments. Micron has undeniably built a phenomenal, world-class profit engine, yet they are now deliberately constructing the exact colossal physical infrastructure that historically triggers devastating industry oversupply. I boldly predict this incredibly volatile technology sector will inevitably face a violent, completely unforgiving reversion to the mean within the next 24 months. I want to hear your take on whether this massive corporate expansion is pure visionary genius or a rapidly incoming financial disaster, so please let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.